Okay. Purpose of government intervention. Government intervention means government is taking charge. Government is trying to control certain situations. Stop right here, please. So for government intervention, it means government is taking charge. Government wants to see. Government wants to know. Government wants to correct something. So government would not be part of it if nothing is happening. That means something is going wrong. So if something is going wrong, government wants to try to change that situation. That is what government intervention is about. You get what I'm saying here? Government is an institution that controls the society. They make law for the society. They ensure that the society is run the right way. So if there's something like government intervention, it would have been as a result of something wrong, something being wrong, or some situation is not right. So that situation that is not right is called market failure. So because there's market failure, government has to intervene to change the situation. Why do government have to change the situation? Governments have to change the situation so that the welfare of the people can improve. So, government intervention to correct market failure. Here I go. There are variety of market failure, from externalities, provision of public goods, and information failure. With government intervention, the total welfare can increase. Government care about us. That's why we have government. So whatever happens in society, the first thing we talk about is, don't we have a government? At least we have a government. These things shouldn't happen. So that means we are thinking about our welfare. So as a result, our welfare to increase, government must intervene. Government must intervene. So if government has to intervene, what do they have to do? They have to check. They have to check on what is missing in that market. That is what we're talking about today. So how do government intervene when it comes to market failure? Government has to correct it. Here I go. Ways in which government can correct market failure. The first one is through indirect taxes. What is a tax? A tax is a levy imposed by government in the course of producing or consuming. A tax is a levy it's a compulsory levy. We have to pay it. Why do we have to pay it? We have to pay it because we are producing certain products or we are consuming certain products. That's why we have to pay a tax. An example of tax is an indirect tax. An indirect tax is charged basically on consumption of goods or services. Though I might say consumption. Consumption does not only mean that you are consuming. In as much as you are buying to produce, you are also purchasing. So what I'm saying is this. As a producer, what you have to produce does not come from heaven. Yes or no? You have to buy what you have to produce. That's raw materials. So buying raw materials means you are also buying. So that means you are buying from another business. So taxes on indirect taxes are examples of purchase of raw material. So that's about production. So what do government have to do? Government wants to reduce market failure. For example, externalities. This is a market failure. Provision of public goods is a market failure because we are not able to get them provided. Information failure or asymmetric information is a market failure. So today we want to talk about how government would try to reduce market failure by intervening in the market. Government can do that with indirect taxes.
Mr. I don't understand the meaning of indirect taxes.
Indirect taxes are taxes charged on consumption. As soon as you purchase something, the tax you pay on that purchasing is called indirect tax. Raw material. As a producer, when you have, this is a product. This is a product, it has to be produced. The materials to produce these things needs to be purchased. Yes or no? Yes. So, the amount you spend in buying the materials to produce this, if taxes are charged on them, it's called an indirect tax. Do you understand indirect tax now? There's raw material. there's production. As a producer, you need raw material to produce goods or services. This is a marker. It needs plastic, it needs ink. All these things are natural resources. We need to buy them. The tax we pay on buying those things that we use in producing this marker is an indirect tax. So here I wrote, imposition of taxes on production which increases negative externalities, such as pollution. I think we know pollution, right? Pollution, like carbon, emission of carbon is pollution. Making noise is pollution. So governments, here we're talking about firms that produce. If firms produce and they emit a lot of carbon, government can impose indirect taxes. If government impose indirect taxes, it means they will reduce their production. So look how it's saying here. The imposition of taxes on production of which increases negative externalities such as pollution will increase the cost of production for firms. As a result, they might produce less. Firms are producing, but they emit a lot of carbon. Because they emit a lot of carbon, government imposed indirect tax. Because emission of carbon will affect the society. So as a result of that, government wants to stop it by intervening through indirect taxes. So imposition of indirect tax will increase the cost of production for firms. The more they produce, the more they emit carbon, and the more they pay in terms of tax. They don't want to pay much. As a result, they reduce their production. As soon as they reduce their production, pollution will also what? Reduce. That is what indirect tax will do. Get it clear. Indirect tax is levied on production, especially those that are polluting the air. So government is imposing it to correct the market failure, because emission of carbon is a market failure. In as much as it affects the society, government tries to reduce it by imposing taxes. The imposition of tax will make firms to reduce their production. Reducing their production means that pollution will also reduce. At that point in time, the main example of using this, imposition of tax will be at EG. So paying more tax will mean that your marginal social cost will equal to your marginal social benefits. Your marginal private cost will equal to your marginal private benefits. So if you produce more, it means both the society and you're going to have the same cost. If you produce less, it means both you and society will benefit at the same level. That is what welfare is about here. Get the point? Indirect tax will increase the amount of taxes firms will pay. Now firms will be paying at EG. The only time firms can reach optimal levels where they can maximize welfare is when the marginal private cost equals to your marginal private benefits, where your marginal social cost equals to your marginal social benefits. That is what we're talking about here. Pollution of tax increases pollution of tax increases reduces the welfare in the society. But we're talking about what will make people be healthy.
So much have to learn, 19 stuff.
Okay. Indirect tax is what we're talking about. For indirect taxes, firms would want to reduce their production because they won't want to pay much. If they pay much, who is going to pay the price? Especially if the goods are priced elastic, they cannot increase price. But they have to pay an increased tax. Paying at this point will mean that they have to reduce their production. Reducing their production will allow them to reduce their marginal cost. So whatever they pay here in terms of marginal social cost will be the same as marginal social benefit. Marginal private cost will be the same as marginal private benefit. Welfare is taken care of. That is about indirect taxes. The government will increase indirect taxes to reduce pollution, and as soon as pollution is reduced, marginal social cost will equal to marginal private cost. Marginal social benefit will equal to marginal private benefit. What is marginal social cost? The cost to the society for producing an extra output. Marginal private cost, the cost to the firm that produces the extra unit. Marginal social benefit, the benefits to the whole society. Marginal private benefit, the benefits to the firm that produces the products. So indirect tax will bring about this. But there's a problem. What is the problem about indirect taxes? Here we said government is trying to increase our welfare. Government is trying to increase our welfare, which is good for the society. But there is a consequence to this, a negative consequence, which is about the setbacks of indirect taxes. Here I wrote, the tax may be too large or too small to correct the market, as the government may lack information on the consequences of imposing such tax in the market. The first problem we have about indirect taxes is that, note, government is an institution. Government are not experts. They are not economists. They are not business people. They are not entrepreneurs. So they might not have information that would enable them to charge the right tax. Get what I'm saying here? The first problem about indirect tax is that it might be too large or too small. That means government might be missing information on what amount of money to charge on tax. Because government is not an economist. They are people that are there maybe through politics. So they don't have expertise to understand how much more tax they have to charge. That is the first point here. So they don't know the amount of tax they have to charge. It might be too much, which is not good. It might be too little, which is bad. Here's the point here. Government needs to charge indirect taxes. That is the point. But how much tax will government charge? Government has to charge a tax that is ideal for the society. Government might not have information to understand the tax that is ideal for the society. Why? Because government is not an expert. Governments are not economists. They might be there based on politics. So they might not have the knowledge to know the amount of tax to charge, which is a problem. The second one, conflict of decision. Government might increase tax to raise revenues and at the same time correct market failure. The amount of tax to be imposed becomes an issue. The second problem about indirect tax is that there is market failure, which is information gap, which is negative externality, which is lack of provision of public goods. So government wants to correct market failure. At the same time, they want to make revenue, because when taxes are charged, it's to increase revenues. This is the reason for charging tax. When revenue increases, public spending can increase. Government can now spend on infrastructure, government can spend on education, government can spend on healthcare. This is the main bone of contention. But here, there's a problem, market failure. There is market failure here. There's market failure. And at the same time, government wants to increase revenue. Government wants to do two things at a time. There might be conflicts. Why would there be conflicts? In the course of increasing taxes, prices might increase, which means the welfare government wants to take care cannot be taken care of. Get the point? Government wants to reduce pollution. As a result, increases indirect taxes. As soon as government increases taxes, especially for goods that are priced inelastic, that consumers don't have any other choice than to buy, those products, the firms will also increase their price. As soon as the firm increases their price, those goods becomes less affordable for consumers. The welfare government wants to take care cannot be taken care of. Then there's government failure. Conflict of decision will bring about government failure, not market failure. So when government makes a decision that is becoming a problem to us, then there's government failure. There's government failure there. Government wants to take a decision. The decision is about to increase the welfare of the people. Increasing the welfare of the people might mean that the cost of production would increase. If the cost of production increases, prices increases. If prices increases, consumers will not be happy about that. The welfare government is taking care of, the welfare of the society that government is thinking about to take care of, will not be taken care of. It brings about government failure. So the second problem about market failure, or the second problem about indirect taxes, is that it leads to government failure, which I'm talking about, a chewing gum in the basket. That's the second one. The third one, taxes are unpopular. People feel reluctant to pay tax, especially if the purpose does not go in line with their objectives. The third problem about indirect taxes is this. As soon as government imposes tax, as soon as government talks about increasing tax, government will tell us why they want to increase tax. Government might tell us that, oh, we need to build a road, or we need to build a bridge in Misrata. Then you are in Tripoli, you have to pay the tax. As a result, for the fact that they are building it in Misrata, you will like, how do I have to pay tax? I'm here, and I have to pay tax to build a bridge in Misrata. I won't pay. Taxes are unpopular. Do we get it? People do not want to pay tax, especially if it doesn't meet or it's not in line with their objectives. So these are the three problems of indirect taxes.